The first week of April 2025 will be etched in the memories of investors as a period of unprecedented market turmoil. On April 4th, the Dow Jones Industrial Average experienced its most significant single-day point drop in history, plummeting by a staggering 2,034 points. This 5% decline sent shockwaves through Wall Street, evoking memories of the 2020 COVID-19 crash. The S&P 500, a broader measure of the U.S. stock market, wasn't spared either, tumbling by 5.7%. The tech-heavy Nasdaq mirrored this descent with a 5.6% drop, officially entering bear market territory. This market freefall wiped out trillions of dollars in market value, leaving investors reeling and analysts scrambling for explanations. The catalyst for this financial earthquake was the re-escalation of trade tensions between the United States and China, a simmering conflict reignited by the imposition of new tariffs. The spectre of a full-blown trade war with its potential to derail global economic growth has cast a long shadow over the markets, triggering a mass exodus from equities. The severity of the market reaction underscores the interconnectedness of the global economy and the profound impact of trade policy on financial markets. As investors grapple with the uncertainty of this new trade war chapter, fears of a global recession are mounting, threatening to push the world economy into uncharted territory. At the heart of this market meltdown lies a familiar culprit: tariffs. On April 1st, 2025, the Trump administration significantly escalated trade tensions with China by imposing a hefty 34% tariff on a wide range of Chinese imports. This move, a dramatic departure from the Phase 1 trade deal signed in 2020, reignited a trade war that had been simmering for years. These new tariffs, coupled with a 10% baseline tax on imports from all nations with a trade surplus with the US, sent shockwaves through global markets. The decision to impose these tariffs stemmed from the Trump administration's long-held belief that China engages in unfair trade practices, harming American businesses and workers. However, the timing and scope of these tariffs, coming at a time when the global economy was already grappling with inflationary pressures and supply chain disruptions, took many by surprise. The move was widely seen as a risky gamble, one that could potentially backfire and damage the US economy as much as it aimed to protect it. The immediate impact of the tariffs was a sharp decline in investor confidence. The prospect of higher prices for consumers and businesses, coupled with the uncertainty surrounding China's response, sent a chill through global markets. The tariffs were widely perceived as a significant escalation of the trade war, raising fears of retaliatory measures from China and a domino effect that could engulf the global economy. China wasted no time in responding to the US tariff hikes. On April 2, 2025, Beijing announced retaliatory tariffs of equal measure on a range of US goods, due to come into effect on April 10th. This tit-for-tat escalation further fueled market panic, pushing the Dow Jones, S&P 500 and Nasdaq deeper into the red. China's retaliatory tariffs targeted key American exports, including agricultural products, automobiles, and technology components. This strategic move was designed to inflict maximum economic pain on US industries while simultaneously bolstering domestic Chinese companies. The impact was immediate and far-reaching. Shares of American companies heavily reliant on the Chinese market, such as DuPont and GE Healthcare, plummeted. Beyond the immediate market reaction, China's response signaled a hardening of its stance in the trade war. The message was clear: Beijing was prepared to weather the storm and engage in a protracted trade dispute, even if it meant short-term economic pain. This tit-for-tat exchange of tariffs injected a new level of uncertainty into the global trade landscape, leaving businesses and investors alike scrambling to assess the potential fallout. Section 4, a rate hike tightrope: the Fed's dilemma. The escalating trade war and the ensuing market turmoil have placed the Federal Reserve in an unenviable position. Faced with mounting inflationary pressures exacerbated by the tariffs, the Fed must carefully weigh the potential consequences of raising interest rates against the risk of further stifling economic growth. Traditionally, the Fed combats inflation by raising interest rates, which cools down economic activity by making borrowing more expensive. However, in the current climate of heightened uncertainty and market volatility, such a move could backfire, potentially triggering a recession. The Fed Chair, Jerome Powell, has acknowledged the precariousness of the situation, warning that the tariffs could further fuel inflation expectations, limiting the Fed's ability to cut interest rates if the economy slows down. The 10-year Treasury yield, a key indicator of investor sentiment and future economic growth expectations, has already responded to the escalating trade war, falling to 4% from 4.8% earlier in the year. This decline suggests that investors are seeking the relative safety of government bonds amidst market turmoil, further complicating the Fed's decision-making process. Section 5. Recession clouds gather a world on edge. The re-escalation of the U.S. China trade war has intensified fears of a global recession. Economists and market analysts are increasingly concerned that the tit-for-tat tariffs, coupled with existing inflationary pressures and supply chain disruptions, could tip the world economy into a downturn. JP Morgan, a leading global financial institution, estimates a 60% chance of a US and global recession this year, a significant increase from their previous forecast. This heightened risk assessment reflects the growing belief that the trade war could have a domino effect, disrupting global supply chains, dampening consumer spending, and ultimately leading to a contraction in economic activity. The impact of the trade war is already being felt beyond the US and China. European stocks have tumbled in response to the escalating tensions, with Germany's DAX, France's CAC 40, and Japan's Nikkei 225 all experiencing significant declines. The price of crude oil, a key barometer of global economic health, has also plummeted, further raising concerns about a slowdown in global demand. Section 6. Navigating the storm: expert opinions and future paths. As the world grapples with the fallout from the escalating trade war, market experts and economists are cautiously navigating the uncertain terrain, offering insights and predictions for the future. Rick Reeder, BlackRock's chief investment officer of global fixed income, aptly captures the prevailing sentiment: the world has changed and the economic conditions have changed. Brian Jacobson, senior investment strategist at Annex Wealth Management, likens the current situation to surgery without anesthesia, acknowledging the painful reality of the trade war's impact on the global economy. However, he also suggests a glimmer of hope, suggesting that the tariffs could be quickly negotiated down if cooler heads prevail. The path forward remains highly uncertain. Much depends on the willingness of the US and China to return to the negotiating table and find a mutually agreeable solution. The longer the trade war drags on, the greater the risk of irreparable damage to the global economy. The stakes are high, and the world is watching anxiously as this high-stakes game of economic chicken plays out.